Do you wonder why Trump suddenly just reversed course on his tariff plan, sending the market into its biggest rally since the pandemic? After causing the worst 4-day market plunge in years, he abruptly paused tariffs for 90 days on most countries except China, where he actually raised them even higher. And you might be asking yourself the question, was this his plan all along? Treasury Secretary Scott Bessent claims it was strategic, but the truth is more complicated than that. And today I'll be breaking down what this means for your portfolio, which sectors are suddenly back in play, and whether or not we're actually headed into a full-blown trade war that could wipe out these gains just as quickly as they appeared. So what happened on April 2nd that sent markets into a tailspin? Trump announced sweeping tariffs on virtually all imports, and Wall Street responded with its worst 4-day plunge since the pandemic. When the market moves this dramatically, it's telling us something important about investor psychology, and in this case, it revealed just how fragile our current market actually is. And what's fascinating is that while many everyday investors were panic selling, something curious was happening behind the scenes. You see, Trump himself was keeping a close eye on the bond markets, allegedly, noticing that people were getting a little queasy. And this wasn't just political theater, it was a recognition that this tariff announcement had rattled markets far more than anticipated, and the tremors were spreading through every financial sector. The market wasn't simply reacting to the tariffs themselves, it was responding to the domino effect these policies threatened to trigger. Investors were visualizing disrupted supply chains, calculating potential inflation spikes, and also forecasting squeezed profit margins across almost every industry. The S&P 500's dramatic drop reflected genuine fear about the broader economic impact of such sweeping trade restrictions. And then came April 9th, the day that everything changed again. Trump announced a 90-day pause on most of the tariffs, keeping them in place for China, and the market response was nothing short of historic. The S&P 500 catapulted upward by 9.52%, making it the largest single-day gain since 2008, and if you were watching your portfolio that day, you witnessed market history in the making. But here's what most casual observers missed in all the excitement. Despite this massive rally, all three major Wall Street averages still closed below their April 2nd levels. Think about that for a second. Even after the biggest market surge in over a decade, investors still hadn't fully recovered their losses from the tariff announcement. And this tells us something critical about the lingering concerns beneath the surface celebration. The CBOE Volatility Index, often called the market's fear gauge, provides another window into investor sentiment during this roller coaster, because after Trump's pause announcement, the VIX plummeted from its session high of 57 down to 33 points by closing bell, and this dramatic swing reveals how rapidly market sentiment can pivot based on a single policy declaration, even without any fundamental economic changes. And Chris Bugatti, chief investment officer at SWBC, captured the mood perfectly when he described the market's upward movement as violent and said it speaks to how badly the market was looking for clarity on this issue. His choice of words, particularly violent, underscores the extreme nature of the market's reaction, and this wasn't ordinary price movements, it was a desperate lunge toward any semblance of certainty. Jamie Cox at Harris Financial Group offered perhaps the most insightful observation about the entire situation, noting that Trump's actions illustrated how incredibly difficult it is to trade around his tariff regime because he and only he knows when it ends. And this perfectly encapsulates the challenge facing investors, which is trying to navigate a market where policy decisions can change dramatically with very little warning. And certain sectors experienced even more extreme swings than the broader market. The S&P 500 auto index skyrocketed by an astonishing 21%, its largest single-day gain ever recorded. Meanwhile, tech giants like Nvidia and Apple saw their shares jump by 18 and 15% respectively. These weren't just ordinary price movements, they were seismic shifts that revealed which industries had the most at stake in the tariff decisions. And when we step back and analyze the market whiplash, it becomes clear that what really drove the historic rally wasn't a change in economic fundamentals. Nothing about inflation rates, employment numbers, or corporate earnings had actually changed or improved. What changed was uncertainty, or more precisely, the temporary reduction of it. The 90-day pause created a window of clarity that investors were desperately craving for. And this episode demonstrates something powerful about today's market environment. Policy decisions can create remarkable opportunities for prepared investors. Those who understood that the initial market panic was driven by uncertainty rather than fundamentals were positioned to capitalize when that uncertainty was partially lifted. And we'll talk about our trade relations with China and how this will affect us all. But if you're enjoying this content so far, it would mean the world to me if you would smash that like button for the algorithm and consider subscribing to the channel if you're not already. It's a free way you can show support, and it is much appreciated. Thank you for doing that. Now back to the content. While policy shifts created opportunities for some investors, what happened with China was something else entirely. When Trump paused tariffs for most countries, he specifically targeted China with an unprecedented escalation. The tariffs on Chinese goods weren't merely maintained, they were dramatically increased from an already punishing 104% to a staggering 125%. And this wasn't just another policy adjustment, it represented a fundamental shift from economic competition to direct confrontation between the world's two largest economies. And global supply chains immediately felt the tremors of this decision. The 125% tariff effectively priced many Chinese goods out of the American market, disrupting established business relationships and forcing companies to scramble for alternatives. For context, a 125% tariff means that a product that normally cost $100 would now cost American businesses $225, a price point that makes most imports economically unfeasible, basically overnight. And China's response was both swift and strategic. Beijing immediately watched the US tariffs with an 84% levy on American goods, but they didn't stop there. Chinese authorities implemented additional measures targeting American cultural influence, restricting the number of US movies shown in Chinese theaters, and they also imposed sanctions on 18 American companies, strategically hitting sectors where the pain would be felt the most. Now, this multifaceted approach reveals China's willingness to use every economic lever at its disposal. And the Chinese Foreign Ministry didn't attempt to downplay the situation. A spokesperson stated unequivocally that the US was openly defying global norms and going against the entire world. Perhaps most tellingly, they added, "China does not want to fight, but it is not afraid of one either." And this unusually direct language signals China's determination to defend its economic interest regardless of the cost. And what makes this situation particularly concerning is that China has been preparing for this moment since the first trade disputes in 2018 to 2019. They've systematically reduced reliance on American agricultural products like soybeans and have developed alternative supply chains as well as pivoted toward domestic consumption. And Chinese leaders also enjoy strong public support for standing up to perceived American economic aggression, giving them political room to sustain a prolonged economic conflict. The Chinese State Council Tariff Commission made their position crystal clear, calling the tariff escalation a mistake upon mistake, severely infringing upon China's legitimate rights and interests, and seriously damaging the multilateral trading system based on rules. And this statement reveals China's intention to frame this not just as a bilateral dispute, but as an American attack on the global trading order itself. So for American businesses with significant Chinese exposure, the situation creates immediate challenges. Tech companies face particular vulnerability due to their complex global supply chains and substantial market presence in China. While the broader market celebrated the 90-day pause for other countries, companies like Apple find themselves caught in the crossfire of deteriorating US-China relations. And despite participating in the recent market rally, their long-term prospects face serious headwinds if these tensions persist or escalate further. And what many analysts aren't discussing is how these tariffs are creating a bifurcated market. Some sectors face existential threats from disrupted supply chains and lost access to the Chinese market. Meanwhile, other industries might actually benefit from reduced Chinese competition. And this divergence means investment strategies that work during periods of US-China economic cooperation may need a complete rethinking. And the timing of this escalation couldn't be worse for the global economy. With growth already slowing in major economies and persistent inflation concerns lingering, an extended trade war threatens to push struggling economies towards recession. And the combination of supply chain disruptions, price increases, and reduced trade volumes creates a perfect storm that could tip economic indicators from concerning to catastrophic. And for investors trying to navigate this environment, understanding the true nature of the US-China relationship has become essential. The 125% tariff represents more than just a negotiating tactic. It signals a structural shift in how these two powers interact. Traditional assumptions about global trade patterns and investment flows may no longer apply in this new reality. And with investors cheering the market recovery after Trump's tariff pause, a dangerous disconnect has emerged between stock prices and economic fundamentals. While headlines celebrate the global market rally, sophisticated investors are watching the bond market tell an entirely different story, one that suggests we might be merely postponing an inevitable economic reckoning. And the EU's response to the tariff situation revealed a calculated diplomatic strategy. Rather than immediately retaliating, the European Commission announced a 90-day pause on their own countermeasures as well. But make no mistake, their statement that all options remain on the table wasn't just diplomatic courtesy. It was a clear signal that Europe stands ready to protect its economic interest if negotiations fail after this temporary truce. And this coordinated global pause triggered immediate market euphoria. Japan's index skyrocketed about 9% in a single session, with other Asian and European markets following suit. Yet beneath this apparent relief lies a troubling reality. These major European indexes still haven't recovered from their pre-April 2nd levels before Trump's initial tariff announcement. The markets are celebrating, but the truth is they haven't fully healed. And what many retail investors aren't grasping is that this 90-day pause isn't a return to free trade, it establishes a new, more restrictive baseline with a 10% blanket duty maintained on almost all U.S. imports. As Jake Colvin, president of the National Foreign Trade Council, pointedly warned, the pause still seems to leave in place a new baseline of 10% tariffs on most countries, plus significant levies on China, steel, and aluminum, as well as autos, with the promise of more duties to come. The uncertainty hasn't disappeared, it's merely been postponed. Colvin further noted that this pause does little to alleviate the uncertainty businesses have faced since November regarding the future tariff environment, and companies remain in limbo, unable to make confident long-term investment decisions when the trade landscape could dramatically shift again in just 3 months. And perhaps most concerning is the stark divergence between stock and bond markets, a warning sign that sophisticated investors are taking very seriously while equity markets soared. While equity markets soared, the bond market flashed caution. The benchmark 10-year Treasury yield, which had fallen below 4% earlier in the week, suddenly rose above 4.3%, a counterintuitive move during a supposed risk-on rally, and this suggests that bond investors, often considered the smart money of financial markets, see significant economic trouble ahead. And Deutsche Bank analysts raised another alarming possibility that the mass exodus from Treasury bonds might signal weakening demand for US-backed assets, a structural shift with potentially serious implications for America's ability to finance its growing national debt. Economic experts remain decidedly pessimistic despite the market celebration. Joe Brusuelas, chief economist of RSM US, delivered a sobering assessment. The economy is still likely to fall into recession given the level of simultaneous shocks it has already absorbed. Even after the tariff pause, Goldman Sachs economists maintained their forecast of a 45% chance of recession in the next 12 months, which is hardly a vote of confidence in economic stability. What we're witnessing is a dangerous divergence between market sentiment and economic reality. The stock market, dominated by retail investors and algorithmic trading, responds emotionally to headlines and short-term developments. Meanwhile, the bond market and professional economists who dig deeper into fundamental economic data see storm clouds gathering on the horizon. This disconnect creates both danger as well as opportunity. The danger lies in mistaking this temporary reprieve for a resolution of underlying economic pressures, and the opportunity exists for investors who recognize that beneath the surface rally, significant structural challenges remain unaddressed. So consider what this means practically. Corporations that source products from China face potential devastation if the 125% tariffs remain in place for long term. Companies that believed this was just a negotiating tactic may be caught unprepared if the US-China economic decoupling accelerates. Meanwhile, firms that have already diversified their supply chains away from China could find themselves with a substantial competitive advantage in this new trade landscape. For your portfolio, this means taking the 90-day window not as a signal to relax, but as crucial preparation time. The bond market's warning deserves your attention. It suggests looking beyond the temporary euphoria to position yourself for the potential recession that economic indicators continue to forecast. And another thing that's worth mentioning is if you're at all interested in any of the merch featured on this channel, like the hoodie I'm wearing right now, it's finance, tax, and entrepreneur themed merch that I actually created for myself. So if you enjoy any of it, there's a link in the description. Anyways, that's all. Now back to the content. So what's the real opportunity here? While others are celebrating the market rally, savvy investors are using this 90-day window strategically. They're diversifying across sectors and asset classes to prepare for multiple scenarios: escalating China tensions, a broader trade war, or potential resolution. The investors who will come out ahead aren't treating this tariff pause as the end of volatility. They see it as a tactical opportunity to adjust their portfolios, find undervalued assets, and implement hedging strategies against future risks. Don't let temporary market euphoria cloud your judgment. Use this breathing room to build a portfolio that can not only weather potential economic turbulence, but potentially profit from the market's reactions to whatever comes next. And as always, if you found this content helpful, please hit the like button for the algorithm and consider subscribing to the channel. It's a free way you can show support and is much appreciated. And if you haven't done so already, check out this next video.